We started from a low at 1,050, December 2015, and since then gold has moved higher in layers, tuned people to think in layers, not think dynamically. But the arm wrestling match bull trend, just like in 2010 to 11, 1979, ultimately says, I'm out of here. No more arm wrestling. Catches up for what it might otherwise have done, and it goes ballistic. Well, if we have an eightfold move, like let's say the 2001 to 2011 move, gold would be $8,000. And that's just doing what it's done before. We have fundamentals that we've been talking about and macro technicals that are far more dynamic, both positives and negatives, that will motivate gold than any time in history. I throw out the 8,000 not as a technical target, but just saying it's done it before.
Gold prices are once again flirting with resistance near $2,400 an ounce. And one research firm expects that it's only a matter of time before the precious metal sets fresh all-time highs. In their weekly note published Thursday, analysts at Metals Focus said that the eventual monetary policy easing from the Federal Reserve will drive gold prices higher in the second half of the year. In this video, MichaelOliver, a Momentum Structural Analyst, reveals the major trends in the precious metal market and shares his favorite assets for the coming years. MichaelOliver observes that gold has risen steadily since hitting a low of $1,050 in December 2015. If it follows the 2001 to 2011 pattern, Oliver suggests it could reach $8,000. Highlighting this as an example of gold's potential in today's dynamic macroeconomic environment. From a technical perspective, Oliver discusses the price movements of silver and gold, noting that while copper and gold have reached new highs since 2011, silver has lagged. He expresses that if silver were valued similarly to gold and copper, it should be above $50. Silver's market potential is predicted to be far from fully realized, despite a commendable 18.5% rise in the spot price this year. Key demand triggers in Western markets, such as the fall in short-term interest rates, have yet to materialize. This suggests that silver's current upward trajectory could sustain or even accelerate as these economic factors come into play. Despite recent trends, MichaelOliver believes silver is undervalued and predicts surpassing $50 will signal the beginning of its rise. He notes that historically, silver has traded at 2 to 3% of gold's price, suggesting that if gold reaches $8,000, silver could rise significantly higher. Now, we present the clips of MichaelOliver's insights from his recent interview with Metals and Miners. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I'm hesitant to say that, except I'll labor on that. If you look back at gold's bull markets in the last 50 years, in the mid-1970s, it woke up, it was in the mid-30s, and by 1980, 10 years later, 9 years later, actually, when I'm talking 1973 or so, 1980 was $850. Wow, what dynamics. Yeah, they were down moves in that. And then you take gold based around $260 in 2001, 2001, went to sleep. Okay. It went from 260 to 1920, did it in 9 years. A lot of that occurred in the last year. Okay. Just like in 1979, 80, a lot of it occurred in the last several quarters. Okay, we started from a low at 1,050 in December 2015, and since then gold has moved higher in layers. It's tuned people to think in layers, not think dynamically. But the arm wrestling match bull trend, just like in 2010 to 11, 1979, ultimately says, I'm out of here. No more arm wrestling. And it catches up for what it might otherwise have done, and it goes ballistic. Well, if we have an eightfold move, like let's say the 2001 to 2011 move, gold would be $8,000. And that's just doing what it's done before. And yet we have fundamentals that we've been talking about and macro technicals that are far more dynamic, both positives and negatives, that will motivate gold than any time in history. I throw out the 8,000 not as a technical target, but just saying it's done it before. Another thing to look at, though, is silver versus gold. And think about it this way. You're looking at a copper chart and you're looking at a gold chart. And in 2011, they each made a high and pulled back. And again in 2020, and then for copper in 2022, made a higher high than that 2011 high. Okay, and then pulled back. And now this year, copper's taken out those two highs and gold's taken out those two highs. Silver should be above 50. If it's, what is it, a dog metal? Or is it an undervalued? I suspect taking out 50 on silver will not be its peak. That'll just be a wake up to people who suddenly realize something's going on here. And if silver went to a normal ratio, a lot of people do the ratio thing. We do a percent. We divide silver into gold. How much is silver an ounce silver versus gold. Right now, it's about 1.3%. If you go back for 50 years, you'll find 20 years plus where silver has traded more at or more than 2% the price of gold, sometimes 3%. $8,000 gold times 2%. Okay, it's off the page. So these are the possibilities that are not abnormal.
During the interview, MichaelOliver stated the recent breakout of silver and gold miners from their underperformance trend against gold, emphasizing their significant undervaluation and potential for substantial gains. With asset managers like Stanley Druckenmiller recognizing this potential and shifting investments into miners, Oliver predicts a strong future performance for these assets. While the gold stocks are starting to close the gap with gold, their leverage throughout this upleg has been notably weak. While gold surged by 33.2% from early October to mid-May, the corresponding gains for major gold stocks, represented by GDX, peaked at a modest 43.8%. This means that the major gold stocks have only amplified gold's gains by a meager 1.3x, indicating a lackluster performance in leveraging gold's rally. Despite the evolution in central banks' influence on asset flows, Oliver mentioned that quantitative easing has become less effective as certain assets become overpriced. He pointed out the historical affordability of commodities compared to past peaks, suggesting a potential shift towards this sector as investors seek lower-risk options. Let's get back to the interview.
We've run spread charts showing XAU index, which has been around since the 1980s, versus gold, and then we also measure GDX versus gold. And for example, in 2020, silver and gold miners beat the pants off gold during that 6-month surge. Oh, they were far better places to be. They beat it 2-3-fold. But then since then, they went into this underperformance pattern. Just like their price went down, their spread relationship to gold declined. So they were underperformers. While gold held steady, they declined. That technical trend is broken. It broke at the same time the annual momentum of GDX and silver broke out. So did the spreads, which tells me that the performance trend of miners, not only is it vastly undervalued historically, but it's now broken out. So expect it to ventilate. And to the extent it's way overdone, it's got a lot of catching up to do. And I think that's why there's a lot of asset managers like Stanley Druckenmiller back in mid-February who dumped a bunch of large tech stocks and went into the gold miners. And, people chuckled probably at the time, what an idiot, Okay, well, Newmont Mining, one of his picks, okay, it was like trading $31. Where's it now? 42? In a matter of a few months. Pretty good percent move. And it's just begun. So I think there's an awareness out there among some asset managers, don't have to be gold bugs. They realize, hey, this category is it's too cheap. You got to buy it. Our analysis says one should be short the stock market. T-bonds might have a good rally, so there's a trade there, not an investment grade. It may last several quarters, et cetera, et cetera. Gold is in a primary trend, and it's accelerating, so is silver and the miners. So you could say, well, I want to be in all those. Actually, personally, I'm speaking now, and each person has his own risk, reward, and so forth. I'm emphasizing silver and the miners, and I'm assuming, and I think I'll be right, that as they accelerate, it will be, in effect, having a short position in the stock market, that will be a factor to help them accelerate, and that there's more dynamic in them in terms of percent gain potential than there is in even being short the stock market bubble in terms of percentage profits on downside or upside. So in effect, I view my silver and miners position as effectively being short the stock market and short the dollar, for example. Though the dollar correlation to gold and silver is not very good, by the way, historically, especially since 2015 low in gold. The dollar's only risen a tiny bit, and yet gold's exploded, so it's not been a negative. But anyway, so I view the gold and silver and the miners as effectively having positions in those other markets. When money flows, there's a river of money comes from central banks. Okay, we know that. They drop rates to free for 10 years, and, people naturally will flow that money into something. The quantity is great, and the cost of money isn't free, effectively. So you put it somewhere. Well, in 2008 and 2009, it made sense. In fact, we put out a report 1 week before the low in March 2009, said this is the major low. Okay. We didn't know it sustained for 15 years. But back then, they printed a lot of money. We know that, QEs. But sometimes the QE doesn't work anymore because you overprice a certain asset category. And so it's not an issue of the Fed printing more money. It's an issue of people reallocating from a perceived two-risk category into a low-risk category. So commodities, as you said, are very cheap. Bloomberg right now is 105 or so. We got up to 107 recently. It's been below 100 in the recent pullback. But if you look at its history, in 2008, it was 237. Okay, we're at 105. And in 2011, it was 170. So the last two peaks were way, way above where we are now. So just looking at the price history of commodities, they're still dirt cheap. Yeah. So if you get another river flow of capital from the central banks, this time investors are going to say, I want to put it in something lower risk that's behaving well. And therefore, it's going to flow back into commodity category.
Gold and silver prices continue to consolidate around critical psychological levels. Still, the uptrend remains on solid footing as investors look for value through the entire sector, including within the mining industry. Do you believe that gold stocks will eventually catch up to the performance of gold itself? Or do you see better investment opportunities elsewhere in the current market conditions? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.